We're looking at potential changes to the rules that would make synthetic risk transfers less appealing to investors. Remember, this has been a red-hot credit trade. We're going to talk about this now with Bloomberg's Esteban Duarte about this. First, let's set up, Esteban, why this trade was so attractive to the likes of D.E. Shaw and other hedge funds.
Well, first of all, because the coupons are higher than in other asset classes. So, for instance, you could, according to the investors, you could see double-digit coupons in those trades. Obviously, that high yield is related to the high risk that you are assuming as an investor. Though. So these kind of trades are related to basically the highest risk portion of a pool of loans. Could be a corporate loans, could be mortgage loans, could be other type of assets that banks have on their books.
Now, quickly here, how also exactly does the trade work? Because you're essentially, as a bank, buying credit default protection off of a certain part of these loan books. How then is that risk transferred to the counterparties?
So basically, the investor is the first in line to absorb losses on a certain, on an earmarked portfolio of loans. So from the buyer of that credit risk transfer, they really need to look inside the portfolio and look the risk that they are assuming. So they need to make sure that they are buying a high quality or taking a risk on a high quality portfolio.
Now,
for the banks, go ahead, sorry.
For the banks.
So just saying that for the banks, the advantage is that they can obtain a capital relief, meaning that they can free up capital that they can use to provide new lending. That's one of the advantages. There are other advantages related, but this probably the capital relief is the most important one.
Well, Esteban, let's talk about what happens as the rules start to change, because one reason the banks really wanted to do more of this, or at least asset managers expected them to do more of this, was potentially very onerous capital standards about to slap them on the head. And if those rules are then rolled back quite meaningfully, how does this trade change?
So you may remember that last week the Fed chairman basically said that they are considering to tweak the initial draft that was released to the market about, basically the market knows that draft as a Basel endgame rules, and they are the indication is that probably those rules won't be as stringent as previously expected. So that means that the banks may not need to use as frequently as previously expected. Doesn't mean that there won't be a market or that banks won't use these kind of transactions, but probably won't need to use it, as quickly or in the amount that the market was, or some part of the market was expecting previously.